Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. He is a successful entrepreneur that retired at a fairly young age, still looks great, a real estate investor since 2012, and his YouTube channel has over 110,000 subscribers and almost 10 million views already in under a year. Very, very impressive. He is kicking ass and taking names on YouTube when many of us are struggling just to get some ad revenues. George Gammon, thank you very much for joining me.
Hey, thank you for having me, Jason. It's great to be here, buddy. I can't wait to let's go head to head with some of these macro topics and really try to sort through for the viewer. Hopefully I can add some value.
Okay, well, before the macro topics, let's just, since I know you like the Austrian School of Economics and you had some more time after you retired being an entrepreneur, how did you find the Austrian School of Economics, and why do you think that it's the most correct in its analysis?
I was at the Marina Bay Sands in Singapore. It's my favorite hotel. It was 2012, and I just retired. I had about 15 minutes to blow before meeting a gal for dinner there. And I think we were going to, I forgot the steakhouse there. Cut, that's right, Cut. I remember that's my favorite steakhouse in Vegas, and they have one in Singapore as well. But anyway, so I had 15 minutes to blow. I was on YouTube, ironically enough, and I stumbled across Milton Friedman's series, Free to Choose. And I just started watching one video and just completely went straight down the rabbit hole. It just made so much sense to me. And it just, he articulated what had been in my mind as an entrepreneur for so long. And he just said it so much better than I could have. So I went from Friedman to studying Soul. And then from Soul to guys like Jim Rogers, Jim Grant, Mark Faber, then Schiff, Tom Woods, Bob Murphy. And so I just kind of gradually made this shift over to the Austrian side. I don't know that I'm married to the Austrian school. I just try to look at the macro environment from a standpoint of just common sense. And it just so happens that usually when you look at things from a common sense standpoint, you tend to fall on the side of Austrian economics. So I think it's not an intentional leaning. It's just kind of that way, just trying to come at it from a standpoint of, what is this? You're supposed to, the further in debt you go, the bigger debt problem, the more money you have to spend and the more debt you should take on. What a minute, that doesn't make any sense. So wait a minute, these guys over here are saying that you need to be more prudent, that savings is key, that production is the key to consumption. Well, shoot, that makes a lot more sense to me.
And Austrian School of Economics was warning about the 2008 financial crisis with the housing bubble. They were warning about bubbles prior to that. Now, the timing of that is tricky. Austrian School of Economics is not good at that. One of the criticisms I have with Austrian School of Economics is it always seems, and maybe there's just a misinterpretation there by some Austrian School economists, is that hyperinflation is always around the corner, is very, very imminent. I mean, that was the case. A lot of people were screaming about hyperinflation in 2008 and 2009. But Peter Schiff, my story is somewhat similar to yours, except I was not a successful entrepreneur when I found Austrian School of Economics. I was just a lowly stockbroker there working in the financial industry. And a little bit before the 2008 financial crisis and then during the 2008 financial crisis. And I had CNBC on and I was watching Peter Schiff talk about the problems in the housing market as before it was happening, predicting it as it was happening, and the name calling. I mean, they were calling him all kinds of names. And I was like, this guy is
laughing at him. Remember that? Just laughing at his face and just incredibly disrespectful.
Yeah, so I bought Peter Schiff's books. I started paying attention to that. I then found the Mises Institute, and I read Economics in One Lesson. I watched over 100 lectures on the Mises Institute YouTube channel. So it makes the most sense, I think, by far, about what's going on right now. Now, the system, though, has gone off the rails at this point because, now they're just going into MMT light at this point. So, but there's so many countervailing forces, though. So there's deflationary forces. Like if there was actually a free market, George, I think there would be deflation, but the people in power, and I think this is important, they don't want to allow it. So they'll change the rules, they'll do bailouts, they'll do all these crazy credit injections or helicopter money, or just handing people checks at this point just because they don't want to allow debt defaults and deflation.
I think that's the key, Jason. You hit the nail on the head, is if the system moving forward remained as it is now, and if the main players, being the Fed and the government, stuck to the rules, such as the Federal Reserve Act, then yes, you most likely would see deflation. And although I'm not sure, because we have so many regulations, we talked about that before we started recording, with the minimum wage and with, wages don't have the ability really now to go down like they did prior to the 1930s. So you would have a lot more supply destruction now than you would have otherwise had. So that kind of keeps inflation there. But my main point is, if the Fed and the government stuck to the rules, then yes, we would definitely have a lot of deflationary tailwind. But if you look at just what they've done over the past 2 months, it becomes blaringly obvious that the Fed is going to completely ignore the rules. They're going to set up these special purpose vehicles. They're going to just do whatever they need to do to prop up asset prices, because they know the economy is built on asset bubbles, debt, and confidence. And that's their game plan. And I think they might even lean, or if they had to weight one of those is most important, it might even be the psychological component. Because through psychology, if you can control the narrative, then I think you can also, to a certain degree, you can control asset prices and the amount of debt in the system. But I don't know if you saw the Macro Voices interview with Dr. Lacey Hunt. It was absolutely phenomenal. I'd encourage all of your listeners to check it out. But Dr. Lacey Hunt articulates a fantastic argument for deflation. But he comes from the view that the Fed really can't create money in the real economy because of the way the Federal Reserve Act is written. And he says, well, they'd have to go through Congress and do all these things. And I just don't see that happening. But Eric pushed him, the host, and he said, okay, well, they haven't done this over the past. I mean, look at this. They're buying high yield ETFs. I mean, where is that in the Federal Reserve Act? And even Dr. Hunt said that, okay, if he called it money printing, because he doesn't consider the Fed creating bank reserves as actual money printing, like a lot of us would. So base money, he doesn't consider that money printing because it's bank reserves. But once they start to have direct control over the M2 money supply or broad money, and they can circumnavigate the commercial banking system, he said, that's when I go from being a deflationist to a hyperinflationist. I mean, he doesn't even stop at inflation. So that's really kind of the line in the sand, is do they stay confined within the constraints that they're supposed to live by, or do they cross that threshold and, to your point, do the MMT light or MMT on steroids in the future, helicopter money, you name it, and really get the velocity going?
I've interviewed Nomi Prinz over the years. She was a managing director at Goldman Sachs, also higher up at Bear Stearns too. And we discussed this with the reserves. The large banks, they don't do as much actual lending in the real economy in the US. They haven't done it in a long time. And velocity of money before the coronavirus, it was falling, and now it's totally collapsed. But the large banks, what they do with the reserves, they use it as collateral. So they start turning it into hedge funds. They've turned into hedge funds. They start using that as collateral to go and gamble in the derivatives market. They use that for big bets outside the United States. So they've just decided that they don't really want to be regular banks too much anymore, because the profit potential on that is nowhere near as much as going and gambling heavily on derivatives, especially when regulators aren't really paying attention to what's going on in the derivatives market. And then given what the central banks, especially the Fed, has done, it's heads we win, tails you lose with the moral hazard. So if
Right.
banks make big bets in the derivatives market, they get to keep all the profits. And then the worst case scenario, there's no bank CEOs or senior executives going to prison for these $1 trillion bad bets that happen. And, the losses are socialized by anyone holding dollars or the taxpayer. And it's, like I said, it's moral hazard, and heads we win, tails you lose. So the losses are socialized then.
Yeah, very well said. And I think that you hit the nail on the head. If someone's trying to figure out why is the system the way it is, and why do banks behave the way they do, it's just, from a moral standpoint, it's sickening. But you've got to, you can kind of understand where they're coming from, because if you're a Goldman Sachs or a JP Morgan or something like that, or just even a Wells Fargo, what we normally consider a retail bank, and you're looking at a pretty flat yield curve. So do you really want to sit and spend your time dealing with $20,000 car loans or $200,000 home loans? And even if you can just tidy it up and sell it off to Fannie and Freddie or whomever on Wall Street and turn a quick profit. But it's pretty labor intensive, and there's some risk, especially do you want to lend a couple $1,000,000 to an entrepreneur to start a business, compared to going out and doing a deal, a derivatives deal, or maybe a leverage buyout or something for $10 billion. And it takes you the same amount of time and energy, pretty much the same labor costs, let's say, but you're just making exponentially more money with potentially a lot lower risk, because you know that if you're doing business, if you're making a transaction in the financial economy, the Fed most likely has your back. So there's Fed put. Now, whether it's real or psychological, that's a different argument, but let's just say there's this Fed put there. So you're the banker. Why? There's almost no downside, but your upside is tremendous. Like, why on earth would you lend money into Main Street? But it goes back to the Fed. If we didn't have these artificially low interest rates, if they wouldn't have bailed everyone out, the corporate sector and the financial industry, in 2008, the system would have cleared. We'd be in a much, much stronger position right now as an economy and as a banking system as a whole to fight the coronavirus. And you would have cleared the system. There would be much less malinvestment, and you'd have a much healthier economy. My concern now, Jason, too, is, like, you look at what we did in 2008 that created the fragility of our current economy over the last 12 years. And we're doing that now times 10. Right? If you look at quantitative easing, who knows if they drop interest rates negative, they most likely will, buying junk bonds. I mean, my guess is they'll buy equities if we have another downturn in the market, because let's call it a second wave of the coronavirus. I mean, they become more and more and more part of the economy, which creates more instability long term. So let's just say the Fed and the government are able to paper over this, what should be a recession/depression with the virus. Well, where does that put the economy coming out the other side? Like, I mean, it'll collapse in on itself the next time we get a 40-mile-per-hour breeze or wind. I mean, it's just, how fragile do you really want to make this thing? And it's an interesting thought experiment, because if you believe we should have let the system clear in 2008, is there an argument for the virus being a good thing? And I obviously, I'm not talking about from a health standpoint. I'm just talking about from an economic standpoint. And I know there's going to be a lot of people say, George, are you absolutely out of your mind? Unemployment's at 20%. People are suffering. And I totally get that. I'm taking the human element component out of the equation and just trying to look at the numbers. But if the virus, if they just let it be and it cleared the system like it should have cleared back in 2008, is it better to clear now or continue to kick the can down the road and try to deal with this in 2023, 2025, 2030, when the Fed's balance sheet is at 50 trillion and we've had negative interest rates for, call it, 5, 6, 7, 8 years? You know what I mean? It's a very,
The system broke a long time ago, and they've
yeah,
been pretending
yeah.
that there was a recovery. And then the bankers who do these reckless trades, they get to pocket all the bonuses, all the commissions, and then no one goes to prison when things blow up. There was tons of hedge funds that blew up in February and March. I mean, the stuff I was hearing from my contacts inside the ratings agencies, I sent you some screenshots of some of the reports. And then also from some bond portfolio managers inside some of these investment banks that I was hearing about these hedge fund managers that borrowed in the repo market. You know, repo is supposed to be safe borrowing. They borrowed in the repo market, leveraged up to the hilt, and then gambled in the derivatives market. So when their derivatives bets went bad and their over leveraged bond bets went bad that were not hedged, they couldn't pay back the repo. So is that the fault then of the person who has money in the money market fund, and the money market fund, because of the central banks manipulating interest rates lower with financial repression, the money market fund's looking for an extra return. So the money markets then are loaning more and more into repo. So you understand then why the Fed felt it had, I'm not in favor of the Fed, doing all these spells, but the Fed felt it had to, because all the money markets had all loaned into repo, and the people who allowed the repo borrowing didn't check to see if the hedge funds and others could pay back the loans and the risk that they were taking with their trades.
Right, and it goes back to the moral hazard. If we would have just let everyone go bust that should have gone bust back in 2008, you wouldn't have this distortion in the financial economy, not to mention the real economy. You wouldn't have these hedge fund guys or these bankers. I'm sure you're always going to have them, but they wouldn't be taking such wild bets to the degree that they're taking them if they didn't feel as though the Fed was going to bail them out. I mean, look at what happens when the stock market goes down by 15% or something like that. I mean, just immediately you have the Fed coming in and saying they're going to do $1 trillion a day in repo. They're doing QE infinity. They're going to print as much money as required. They're going on 60 Minutes and saying that we have an unlimited amount of tools at our disposal. And it's like, what are you talking about? I mean, go back to the 19 whatever 50, if you even go back to the 1970s, Jason, most people don't know this, but between 72 and 74, the stock market went down by almost 60%, 60, right? So did we have the Fed coming in and doing all this Operation Twist and the MILF program and the PPP or whatever it is? You can't even keep track of all these crazy acronyms. No, it's the stock market. Yeah, if you got equities, you're going to get burned. But it really didn't transfer over into the real economy. But now, my goodness, if the Fed and everyone else know, well, maybe not everyone, but most people know that look at this stuff like you and I do, that if the market were to go down by, call it 40, 50%, that would have a massive, massive impact on the real economy. And people go back to 1929 and the stock market crash and say, oh, well, look what happened there. It triggered the Great Depression and blah, blah, blah. No, it didn't. You're associating correlation with causation, right? Because look at all these other stock market crashes that went down almost as much or more violently, such as 1987. And that doesn't trigger some sort of massive 10-year depression. So it's got to be, that could have been one component, but there's got to be other things there at play. But it really just goes back to the Fed distorting everything and creating this behavior that's destructive, that builds an economy on a foundation of sand. And another example I used today, Jason, on a different interview is, as you know, I've spent quite a bit of time in South America, and I was in Ecuador for a while. And I can't remember exactly off the top of my head, but the cost of fuel is subsidized quite substantially there. So gas is like 75 cents a gallon, let's call it. And it's been this way for, as far as I know, like 20, 30 years, right? Just like Venezuela. In fact, I think Venezuela did it to a greater extent. But you can imagine what would happen to an economy like the United States, even if we dropped or subsidized the price of fuel and diesel down to, let's say, 50 cents a gallon, right? And we did that over, let's say, or even lower, 10 cents a gallon, whatever it is. And we did that over the span of 10 or 20 years. And then all of a sudden, you try to rip the tablecloth out from under the silverware, right? Just think that there's no way the economy could stand it. Why? Because it's been built around this price, this subsidy, this artificial price. Well, think what we're doing with the most important price of them all, and that's the price of money, interest rates. Money is one half of every single transaction, or maybe better said, currency is one half of every single transaction. So if we're manipulating the price of currency, just think how much we're manipulating the entire economy. And we've built this economy over the past, call it, we'll even go back to 2000, where it's lower and lower in artificial interest rate. And we've got these price distortions. And again, it just creates a house of cards that eventually has to tip over. The question becomes, how big is the house of cards going to be? How big are we going to build it before it finally does tip over?
Well, they have to keep changing the rules, and they have to keep doing larger and larger bailouts. That's part of
Right.
the problem. But I
Right.
think things went haywire starting in the 70s, the last link to the international gold standard. And then
Yep.
once the over-the-counter derivatives market started being implemented, and it just exploded in size. We have a quadrillion, depending upon which estimates you look at. It's either hundreds of trillions in gross over-the-counter derivatives or up to a quadrillion in gross derivatives. And the banks who go on, the hedge fund managers, the people in investment banks who go on TV tell us that all these things are netted out, not to worry. But the total amount of debt in society at all levels, at the government, corporate, small business, family, individual levels, there's way too much debt. I think we're way over $254 trillion. It's grown over 20 trillion in liquidity injections in just the last couple months from central bank balance sheets and fiscal stimulus from governments. In only a couple months, another 20 trillion. That mathematically, George, that debt, that total debt, it can't be paid back. And now with the cash flow problem we have, can it even be serviced appropriately? And then you have the derivatives market, which is always hanging over. And all it takes is one or two dumb large banks or a couple large hedge funds to make some really, really dumb bets and not be able to pay back the bets that they borrowed from repo. And then I think this started, you were covering this before anyone else, you and me were, in September, and people were making fun of us that we were making a lot out of the repo stuff, out of repo madness. I think it started back then, and the hedge funds and the banks that got crippled back then, they limped along until February.
Yeah. I mean, I think if you listen to Jeff Snyder, he would take it even further back to 2008. There's a specific date, I mean, down to the day, where I believe it was LIBOR and Fed funds completely went separate directions. And up until that point, they had pretty much moved in lockstep, because you've got the price of dollars outside the United States and the price of dollars inside the United States. So if the dollar is fungible, those interest rates should be in lockstep. And they completely, one went straight up, one went straight down. And according to Snyder, that's the point at which the system, if you will, the dollar funding market, completely broke, and it's never been fixed. And we just have these annual blow up or biannual blow ups where you can just see kind of the steam coming out the side of the volcano, because there's so much pressure that's being built. It's just, at what point is it going to explode?
The over-the-counter derivatives market is larger. There was over $5 trillion in derivatives failures in 2008. Like Lehman Brothers' balance sheet was. I was listening to an interview with the former vice president of Lehman Brothers, Lawrence McDonald. Maybe you should have him on your show. I have to reach out to him for the Bear Traps report. He wrote a whole book on the failure of Lehman Brothers. Lehman Brothers could not borrow in repo. They had bad collateral problems. I think they couldn't even borrow collateral in repo. That's how bad things were with Lehman Brothers. But their balance sheet was a disaster, and that's why they went bankrupt, because no one wanted to lend to them. Their balance sheet was 44-1.
Yeah, but think about how fast a bank's balance sheet can blow up. And I don't know their balance sheet, and I don't want to completely speculate. So just take this with a grain of salt. But let's assume that one of these big banks' balance sheets, although you look at it, oh yeah, it looks good. Looks like they're well capitalized. Well, okay, let's say that they've got this commercial real estate book that I know this is one thing you wanted to talk about. And let's say that the prices of these loans that they have as assets on their balance sheet go down by 50%. Well, okay, now what does their balance sheet look like? Well, you can go from looking good to having negative equity and being insolvent almost immediately. And then going back to your layman point, they need the liquidity to run their day-to-day operations. And if no one is willing to take the collateral on their balance sheet, does it matter if their balance sheet looks good or not if they don't have the liquidity? And then you come in and say, well, now the Fed is providing all of this liquidity, but maybe not. I mean, I brought this up going back to Snyder again. And one thing that he said is, look at Japan. Look at the Bank of Japan, and they've done everything that the Fed is talking about doing, whether it's buying ETFs, whether it's owning, 60% of the JGB market, something insane like that.
It might be 80 now.
Is it 80? Yeah. And they still haven't been able to prop up prices, because at the end of the day, although the Fed, I dislike them just as much as anyone else, they're still a bureaucracy, and they don't have a profit and loss, so they're not going to be as dynamic, or theoretically, they wouldn't be as dynamic as a business out in the private sector that had to worry about doing the right thing, because if they don't do the right thing, then they're going to actually lose money. They've got skin in the game, right? And now you could argue that the Fed is doing these things because there's some malicious game plan, and I totally understand that argument. And you can also argue they're doing this because they're just utterly incompetent, and they're just completely reactionary. And at the end of the day, regardless of what they try to do, it may or may not happen. And if it does happen, it's just because they got lucky and they were able to convince the market from a psychological standpoint to do their bidding. But I think those are interesting takes. And I love trying to go back and forth in my mind to figure out which one has the most or the highest probable outcome, or which one has the most likelihood of actually coming to fruition or being accurate. And I don't know if you saw the Princes of the Yen, the documentary based on Professor Richard Werner's book. I'd suggest that to all of your viewers. It's free on YouTube. But that really presents a fantastic argument for the camp that is saying the Fed this is their game plan. It's malicious, and it's all to consolidate power in the banking system and eventually make them, the central bank, the only bank in the game.
Well, if you're Austrian school and libertarian, you know not to trust the government and not to trust the banks and not to trust the Federal Reserve and other central banks. So there's always been not just a level of skepticism, there's always been like a hatred and mistrust for what the government and government bureaucrats and government agencies, and especially central banks and the Fed. Because look at the history of central banking here in the US. Most people aren't aware of that with the two Bank of the United States, and how difficult it was just to get rid of those two, and then the secrecy of the Federal Reserve being passed.
Yeah, that's right. And it's that, I'm not going to say it's to that extent in other countries, but if you look at the central banks, Japan, the ECB, they're well, they might not be equally, but they're suspicious. Let's just
Well,
put it that way. They're very suspicious as well.
I've spoken with people who have worked at the Fed and then left the Fed, and a lot of them are not really malicious. They just believe that the deflation is bad, and that if they subsidize interest rates, that eventually it will trickle down to the right small business owner or the right, person on Main Street. They really do believe that. I mean, Ben Bernanke he actually thought, if you've seen some of his comments, he thought that the loans, the reserves that he was putting into the system in 2008, 2009, that would be lent out. So instead, the banks turned that into more shale bonds, probably shale junk bonds, and gambling on dollar-denominated debt outside the United States to emerging markets, and loans into China, and gambling in the derivatives market. So they really do think, and it's the wrong way of thinking, because I think, again, we have to go back to deflation. If someone doesn't have a lot of debt, if they save, if they're a prudent investor, they produce more than they consume, they save the difference, they learn how to invest it, deflation benefits them, or at least it should.
Yeah.
And in the system that we have now, they won't allow deflation, and then they're trying to change the rules. Potentially, you've covered this on your excellent videos, negative interest rates. So that's another thing to set up to try to force people to not save, to try to prevent against deflation, so people don't save, don't hold cash, and they spend it.
Yeah, which will actually decrease the money supply and potentially lead to higher deflation, or at least deflationary pressures, ironically enough. It's really, I mean, I understand what you're saying, and I always do my best to try to put myself in the position of someone at the Fed and try to give them the benefit of the doubt. But also, even if we're to say that they're trying to do what's right, and they've just got these Keynesian models that they've learned growing up in high school and college, or getting their PhD or whatever, and they're just sticking to these models. They're really trying to do what's right, but still they don't have the humility or just the common sense to know that there's going to be massive unintended consequences in what they're doing. It's like they get so fixated on the model, and if the model says you need to lower interest rates by 500 basis points, regardless of where interest rates are, if we're at the zero lower bound, if we're at 5%, whatever, you just need to lower 500 basis points because that's what my model says, Jason. Without getting outside of that and saying, well, what could the unintended consequences be? And I've got to be humble enough to know that there's going to be unintended consequences. Let me just try to think through, and so I can determine on net balance whether or not lowering interest rates by 500 basis points is really the right thing to do, even though my model says it is. And that's kind of, if we're giving them the benefit of the doubt, that's still kind of a point of contention I would have.
Well, what I would say is there's no consequences or accountability for them being wrong. They could be wrong as many times as they want, and they could just keep papering it over. Plus, they don't lose their job. If you and me are wrong building our businesses, or we're wrong as investors, we have very painful consequences.
Yep.
And if you're a Federal Reserve employee, if it's the Peter principle. It's like a more resourceful Department of Motor Vehicles, but they're managing more important things with they're managing the currency, they're managing interest rates, they're managing the cost of capital, they're picking and choosing winners, which corporations get bailouts. They allowed Lehman Brothers to fail, and then that made them have to do even larger bailouts. So there's no consequences to them being wrong. That's part of the problem. In the real world, when you make big mistakes, you're risking your career, and they don't have to worry about that. They have way too much power and control.
And I'd take it a step further. If you think it through, if you're at the Fed, or I think you could argue at a big bank, it's much better to be wrong as long as everyone else is wrong than to try to go against the grain when you think that everyone else is wrong and you're right. Because if everyone else is wrong and you're wrong, then you're still going to keep your job, right?
Yeah,
If you go,
Keynes
if you,
said something like this. Yeah, it's better to be wrong with everyone else than the one person who's right, because people are going to hate you anyway.
yeah, that exactly. Then if by chance you're wrong, and you went against the grain, then you're definitely going to lose your job. So there's a lot of risk involved if you're in one of these bureaucracies, whether it's a big bank, a huge corporation, or the Federal Reserve. There's a lot of risk there if you try to go against the grain and have some sort of opinion, like from an Austrian standpoint, or maybe question the fact that, hey, maybe what we're doing isn't what we should be doing here. Maybe there are maybe the unintended consequences outweigh any positive effect we could have by doing this short term. And it just goes back to government. And I mean, you hit the
You
nail on
sound
the
really
head.
frustrated. Yeah.
Yeah, it's just whenever there's not a profit and loss involved and there's no consequences for being right or wrong, then you're going to get worse results, period.
This also, George, the same mistakes are made over and over and over. There's no learning from the mistakes.
Yeah, because see, then you go into like cognitive dissonance, right? Because now put yourself in the position of like a Krugman. So you are no, your identity as a male, which is very important to us guys, is you are the number one go-to guy for the Keynesian School of Economics. You have your PhD, you've won a Nobel Prize, you've got a column in the New York Times, you're well respected. When you go out to dinner, everyone knows you. All these hedge fund managers try to buddy up to you and all these things. This is really your identity. So can you imagine someone who's, let's say, 50 or 60 years old coming to the conclusion that, oh my gosh, I've been wrong all these years. You know what? That Hyatt guy, he was right. I was wrong. He's never going to do that, because from a psychological standpoint, it would cause way, way, way too much anxiety. And we as human beings want to avoid that anxiety, at all costs. Therefore, we'll rationalize what we're doing or the decisions we've made any way possible to make sure that what we've built our lives around, or what we've built our identity around, stays intact. And you can see this if there's been a lot of psychologists or whatever that will fall around these doomsday cults, and these cults that have like a day in time when the world is going to come to an end and the spaceship is going to come down and grab all of the followers. And let's say that's September 16th or something like that. And the psychologists will follow them and go out to their area wherever the spaceship is going to pick them up. And sure enough, it'll be in the morning, everyone's excited, and then by midnight, obviously the spaceship doesn't come. And you would think, as rational people, these cult followers would say, oh, wow, I guess we're wrong. No, what ends up happening is their belief system becomes even stronger. Why? Because of the cognitive dissonance. And I think it's the exact same thing with these PhDs at the Fed and their Keynesian economics.
It's just easier to blame capitalism. I mean, whenever there's a problem, right? It's just blame capitalism.
Yeah. Well, you got to blame anything other than your belief system, because it would be too painful for your belief system to be wrong.
And when the gold price goes higher, when we do get $2,000 an ounce gold in the near future, then they'll blame those evil, greedy speculators that cause the gold price to go up. And that's what's causing problems in the U.S. economy and the banking system and the dollar. It's those evil, greedy gold bugs. It's their fault.
It's Jason Burack. Damn him. It's that stupid YouTube channel. If we could just get rid of that, we'd solve all of our problems.
Well, your YouTube channel is bigger than mine, so you'd have a bigger target.
Yeah, they're coming after both of us, buddy.
Since you've interviewed so many people now for your YouTube channel, what are some of the best lessons about investing that you have learned from having long conversations with so many experts?
That was such a good question. You sent me these questions, and most of them I can just answer right off the top of my head. But that one, I actually had to give it some thought. So I wrote down a couple of things here. First and foremost, I would say the best investors, or the people who think through this in a way that I think most should emulate, are guys and gals who almost ignore the future price direction and focus almost exclusively on the value of the asset that they're considering. Meaning, instead of the first question being, do I think the price is going to go up or down? Or do I think the market is going to go up or down? Or am I bullish on the market? Am I bearish on the market? That's not their first question. It might not even be in the top 10. What is their first question is it cheap or is it expensive? That's their starting point. And then they look at probabilities. They never, ever look at certainties. They're always under the assumption that they can be wrong. And they are always playing the game, understanding that they're probably only going to get the direction right if they get to that question at all. They're only going to get the direction right maybe 50% of the time. So then it becomes a game. It's really the opposite of the way most retail investors play the game, right? They're looking at each individual transaction as though it's its own speculation or its own investment. Where I think the pros do look at the individual plays or bets, if you want to call it that, but they look at it within the context of their overall portfolio and what their objectives are. And I don't even know that a lot of the experts I've interviewed are cognizant of the fact they do it. but the best do that whether they know it or not. And I would use Jim Rogers as a perfect example of that, in the sense that if you look at the way he invests or speculates, from a mathematical standpoint, if you reverse engineer it, you can see why he's done well. Because I always look at it as there's three components to a portfolio. You've got the probabilities, you've got volume of transactions, and you've got asymmetry, right? So if you have low volume, you have to make it up by either having high probability of outcome or extreme asymmetry, right? And it just goes, and I don't want to bore your audience with a binomial calculator and whatnot, but it's just making sure mathematically over the long run that if you're correct on your assumption of probabilities, that you're going to do well, that you're going to actually make money. So Rogers, as an example, has a very low volume, right? So in order to make up for that, he'd have to have very high probability, but he doesn't. I think he'd even admit that he only gets it right, maybe call it 30 or 40% of the time. So how does he make up for that? Because he has massive asymmetry. So if he loses money, let's say he loses, call it 10%, right? And he's a very long-term guy, so he'll hold on to something for, call it 3, 5, maybe even longer than that years. But if he makes it, he makes 2,000, 5,000%. Why? Because he's going into Venezuela. He's going into Zimbabwe. He's going into North Korea. He's going in buying ruble-denominated bonds in 2015. All these things that nobody wants him. No one would touch him with a 10-foot pole. Everyone says that's the craziest investment. You may be right, but there's a lot of asymmetry there, right? So my whole point by outlining this is showing the difference from what I've seen and how the pros look at their entire portfolio compared to the retail investor. Like the retail investor doesn't see it as a lump sum, achieving an objective and then working the math on the whole portfolio on the probabilities of you making money. I think the pros do, right? So that would be another thing. Also, let's see, let me go down my list here. Oh, you know, another thing that I really like to listen to people who manage money and what their opinion is on things such as the virus, right? So you hear I mean, you got the right over here, they're claiming that it's nothing, it's a fluke, or it's fake news, it's just like the flu, or it's just like a cold. And then you got the left over here saying that it's the black plague or something, or the Spanish flu. And it's just, you can tell what people's opinion is based on which news channel they watch or what side of the aisle they're on, unfortunately. Where a hedge fund manager or someone who invests their own money, they can't afford to have a political bias, because if they're wrong, they're losing money. If they're right, they're making money. So if you've got that on the line, if you've got that much skin in the game, you can't afford to sit there and just blindly watch MSNBC and accept everything they say as fact. The same thing with Fox News. You can't do that, right? So they don't have the luxury of having a bias. So that's another thing that I've noticed with these money managers, where I like to get their opinion not only on the financial component, the economy, but also on other things, because I think they train themselves to look at just the data and the facts and try to eliminate the noise, I think is the best way of saying it.
I think a common mistake among retail investors, and I have a lot of retail investors who are my patron account contributors now, who take a look at my articles, and some of them don't like my articles. They get a lot of criticism because I try to balance them between risk and reward, what could go wrong, why
Right.
something is happening in a market that's means that these companies will not do well. So I try to balance these things out so people are looking at things through a certain perspective here, seeing what's the upside versus what's the downside, what's the risk. The average retail investor, and I worked in the paid newsletter industry for a full year, and unfortunately, that industry is very, very guilty of this. I've read a bunch of paid newsletters I've gotten free copies, I've paid for them in the past. And the paid newsletter industry as a whole, now there's some people that are really good at this, but as a whole, they don't do a good job. They only talk about the upside a lot. So they
Yeah.
tell a story. They tell a
Yeah.
story and it
Yeah.
sounds really good. And in the average retail investor, even though it's written in all capital letters, that you should not put all of your capital into any one or two stocks. You have to have a model portfolio. You have to have some type of diversification. And the average retail investor ignores this. And then they read these write-ups, these articles, and they only see the upside. They see the chance to make 5 times or 10 times their money. They don't think about, well, I should have protection, defensive positions. I should have cash. So let's say, like with gold stocks, for example, there was the big sell-off, right? There was the liquidation event the first week of March. But if you didn't have cash to go and buy Franco Nevada at $85 a share or Sandstorm Gold below $4 a share, you didn't have the cash to take advantage of that when there was the market was irrational and the baby got thrown out with the bathwater.
Yeah.
So the average retail investor would have read a story about some of these stocks and they would have bought all of their position all at once. They didn't have any cash to take advantage of the opportunity. So I think that's something that's important is, like you said, they don't know if they're right all the time. And one of the ways to protect yourself is to have cash.
Yeah, I agree. And I think I have the benefit of being obsessed with blackjack a long, long time ago, actually, right when I kind of started my entrepreneurial career. And there's no way I would have done as well as I did in business or investing, for that matter, if I wouldn't have been so involved with the study of blackjack and kind of how it works. But it takes me back to the mindset where it's not about, if you try to make money, you're almost inevitably going to do worse than if you try to play the game correctly. It's a big difference, right? Like in blackjack, as an example, if you get a specific hand, and the dealer is showing a certain card, there's a way to play that's correct. And regardless of whether you lose the hand, whether you lose money that day, whatever, you just have to play correctly, because if you play correctly over the long run, you're going to make money. And it goes back to exactly what you're saying. I've noticed that if people come at this from a psychological standpoint of just trying to maintain their wealth, I think they're going to, ironically, they're going to make a lot more money than if they look at it from a standpoint of trying to get rich. Said another way, if people would just do everything they can to stay rich, even let's just say they're not, I think they're going to get rich faster than if they go out with the intention of getting rich, excuse me. And it goes back to what you're saying, because they're going to manage their portfolio in a lot smarter way. They're going to play the game correctly, and they're going to have that cash. They're not going to just listen to any newsletter writer, and that it's going to, just because they give a stock pick. That's one of the things. I've got an affiliate program, and I work with a couple newsletter people, and I'm actually considering doing my own product, the Rebel Capitalist Pro, where I partner with a couple people that have research. And it's one thing that I always tell my viewers. I say, listen, if you're considering buying a newsletter or a research letter because you want a hot stock pick, or you just want something that's going to quadruple in the next month, don't do it. That's the absolute wrong reason to buy research. Just save your money, because you're going to lose it. If you buy a research paper with the intention of using it as an employee, like I want to hire a research analyst just to give me information that I require to make my own decisions, I think that's the way you have to look at a research paper. But it also goes back to the mentality of most people are so impatient, and they're just trying to invest to get rich. Even the gold people, Jason, even the gold Austrians. I mean, look at the way they talk about gold. When is it going to 10,000? When is it going to 50,000? Oh my gosh, if we go off the fiat currency and we go to a gold standard, oh my gold, it's going to go from 2,000 an ounce to 50,000 an ounce, and I'm going to be rich, and I'm going to pay off my home mortgage just with an ounce of gold, right?
What's everything else going to cost at those gold prices?
And your taxes and your cap gain taxes. Let's not forget about that.
Yeah.
So, but you understand my point. It's that most 99% of the retail investors out there, they're investing to try to get rich. And I think that is their downfall. If they would just invest to try to stay rich or maintain their purchasing power, ironically, I think they do much better over the long run.
Yeah, I agree. And I actually set up to talk about the gold example there. I actually used to believe a lot of those gold experts when I was first learning about the gold market and the paper price manipulation in gold. I've been flown up to Toronto Sprott Inc. headquarters in Toronto twice, and I've gotten to speak with Eric Sprott personally about the paper price manipulation. And I'm friends with the Gold Antitrust Action Committee, and I've interviewed a lot of those people over the years. So I actually set up my portfolio now with my gold exposure, silver exposure. So the more paper price smashes, if the bullion banks, if the central banks want to decide they want to play games in the paper gold market, want to cap the gold price temporarily below 1,800 an ounce or below 1,700, my portfolio set up now so I actually benefit in the long run from it. There's ways to do that. There's companies, and I figured this out. It took me a number of years speaking with CEOs, studying which companies have benefited. I mean, if there wasn't massive amounts of paper price manipulation, there's no way Franco-Nevada would have a market cap over $15 billion and would be generating over $600 million per year in cash flow. They have taken advantage of all the paper price manipulation in gold. They've done an incredible amount of deals over the last 12 years that I don't think they would have been able to do if the gold price had already gone to $5,000 or $10,000 an ounce. So they've done all these smart deals for long-term cash flow. Now they're just a cash flow machine.
See, this is a perfect example of what I'm talking about, Jason. I don't have time to do that type of research. There's no way. I just don't have the time to do it. So why would I not pay you as an employee, not literally as an employee, but as kind of like an employee, to do that homework for me, because you're doing it on a daily basis. And then all I have to do is get the summary from you, because I know you're doing the research. And then I'm not just going to say, oh, well, what does Jason tell me to buy? I'm just going to buy that. No, I'm taking all that awesome research that you have on your Patreon page. So if you're not a patron of Jason, make sure you go there right now and sign up. It's only $5 a month, for heaven's sakes. But you take all this awesome research you're doing, and if you don't have the time, if you're like me, you don't have the time to do it yourself, you can still get the benefit of the research, but you use it to make your own decisions and to make your decision-making process even stronger, not to delegate your thinking to someone else.
I did not pay you for that endorsement.
No, you didn't, but you should do it anyway. Make sure you check out Jason's Patreon page. And I've been actually listening to Jason since 2012. Back then you had your podcast, or it was either 2012, probably 13, 14, right around there. But that's when you had your first podcast, Wall Street from Main Street, and you interviewed all the guys that we all like to listen to, and then you kind of transferred over to YouTube. But my point is, Burack has been doing this a long time. He's an OG, and you got to check out his stuff.
An OG who sounds like he's 25 years old still.
Exactly.
I don't want to wrap it up here. I want to get your thoughts on the real estate market, because you've been a successful real estate investor since 2012. You know, I see potentially down the line. You interviewed Danielle DiMartino Booth about this recently. Excellent interview. I saw that.
Yeah.
I highly recommend that.
Peter Bookvar today too, by the way, on real estate.
Who was what?
Peter Bookvar. I talked to him today about real estate. He's good buddies with Danielle.
Yeah, I interviewed Peter a couple weeks ago as well. So I think personally, there's a train wreck coming if the economy doesn't get back to normal economic activity, if cash flows don't resume in the economy. So do you think that there's a cash flow problem globally, and how will it affect real estate markets, commercial and residential, in the coming months?
Okay, so I do think there's a cash flow problem, and I think there's going to be an insolvency problem. And I think it's going to have a massive impact on commercial real estate. I think it's going to have a big impact on certain sections of residential, but whether or not it has an impact on the entire residential market, I think depends on how long the recession/depression lasts. Right. So let's look at this at extremes to try to get our head around it. Looking at I think the commercial argument is very well known. You look at someone like WeWork or the Sears or all these companies who just filed bankruptcy. I think J. Crew, Neiman Marcus, all of these things. I mean, the future for commercial real estate is grim, to say the least, from a fundamental standpoint. So going back to the residential, taking it to the extremes, you've got these, let's say, $3, $4, $5 million condos in Los Angeles and in New York. Compare that to $100,000 home or $150,000 home in a good neighborhood in Little Rock, Arkansas, or Cleveland, Ohio, Indianapolis, Indiana, or Kansas City, where I like to. I've got several rental properties. That's two completely different questions, right? So would I be bearish on the $5 million condo? Yeah, I would, because even if I see this stagflationary environment, I see potentially a deleveraging from a debt standpoint. So although I see food prices going up, I don't see the price of Bentleys going up, or Ferraris, or even $100,000 Ford pickup trucks, because anything that someone needs to buy on credit, I think the prices might actually come down in even maybe a year, 2 years. I don't think they can stay down for long because of what we discussed earlier. But, while the prices of food and everything else are going up. So assuming that you got to take out credit to buy a $5 million condo, I see there being a lot of pressure there. Now, I understand that you'd have to take out credit to buy one of these, smaller single family homes, but you're kind of at the bottom of the totem pole, right? So if you've got, let's say you're trying to cater to a individual that's making $50,000 a year. Well, you've got people making 50, 100, 300, 500, right? Even if the economy gets really, really bad, you're going to have the person that was buying the $300,000 home. Well, now they're going to notch down to the $100,000 home. So there's still kind of a bid there, right? Now, I'm not saying that the lower end of the market is completely insulated, by no means. I mean, I'm someone that I think that the housing bubble is just as big now as it was back in 2006. And I think the charts would definitely back that up. If you look at a chart of residential prices across the United States going back to 1900, adjusted for inflation, you can see that there's a specific trend line there. And prices really didn't move when you adjust for inflation and the size of the house from 1900 all the way to 2000. So 100 years and prices didn't move. Okay. Then, of course, all of a sudden in 2001, 2002, we have this just hockey stick, this parabolic move in U.S. home prices that peaked out in 2006. Of course, they come all the way down to their historic trend line, 2012. And oddly enough, wouldn't you know it, that's where they bottomed out. Shocker, right? But then my point is now they're almost as high, if not higher, in some markets than they were in 2006. So if we were in a bubble in 2006, how are we not in a bubble now when prices are as high, if not higher? So again, my point is I understand there's a bubble there, but I think that there's components of the market that could be a little more insulated. That said, it depends on what happens long term. So if we go through a recession / depression and it lasts a year or two, I think that you're going to lose less money, or those prices are going to go down with those lower tier homes a lot slower than stocks or potentially bonds or the high end real estate that we were talking about that you need a lot of leverage. But long term, I think that could change. If we go into let's call it a depression for the next 10 years, all of a sudden, I think people are going to change their behavioral patterns. And Americans are going to be a lot more like South Americans and Europeans, where you're cramming more people into the same square footage. And the biggest Achilles heel for residential real estate is a reduction in population. Well, if you have more people living in the same amount of square footage, then in essence, that's kind of a reduction in population, right? So that's kind of how I look at the residential component. You've got to break it down by specific markets that go up and down, like New York, like Seattle, San Francisco, Los Angeles, Miami. And then from there, you have to break it down even further by where it is on the totem pole and how much debt you need to buy it. Does that make sense?
Yeah, and you did a short video recently, an excellent one about hidden problems in the real estate market. And one of the stories you were talking about was this guy from Airbnb, I guess, and it was near Universal Studios, I guess, in Hollywood. And
Yeah.
he had a certain projection for his cash flows, right, to cover his mortgage payments. But he had enormous property taxes due, insurance payments, property taxes, mortgage payments. So governments are really, especially the counties and the municipalities, local governments, very, very reliant on property taxes. Is there a scenario where you see, are they going to keep increasing? Are they going to keep trying to increase property taxes no matter what, no matter if real estate prices fall, if tenants, property owners don't have tenants for cash flow?
I think they have to, unless the Fed comes out and bails out the pension funds, because I think that's the only release valve. And ironically enough, or unfortunately, the tax receipts are very correlated to the economy and even the stock market. So if you go back, and I'm sure you've done this, but very few people have, people get confused and they think that there's a direct causal effect between the highest marginal rate and the tax receipts relative to GDP. And there's not. So you go back and look at decades where the highest marginal rate has been, call it 90%. And you look at the tax receipts as a percentage of GDP, And then you look at the 1980s, where let's call it, the highest marginal rate was maybe 25%, 29, something like that. And you'll see that the tax receipts compared to, as a percentage of GDP are very similar. So it's kind of a head scratcher. You're like, what? And then, of course, at the end of the Clinton years, of course, the tax receipts increased. So you can say, oh, aha, that means that higher marginal rates equal higher tax receipts. But then if you go back and back test it, it's almost an anomaly. And so then you say, well, if it's not tax rates that are driving tax receipts, what is? And sure enough, if you look at the crashes in the stock market and the recessions, that's when people don't pay their taxes, regardless of the rates. So my point is, if we go into a recession or a depression, regardless of what they do with tax rates, most likely tax receipts are going to go down. And that's relative to GDP. Keep in mind, GDP is falling at the same time. So yes, the Federal Reserve can print all this funny money for the federal government, but how does that get to the state level? So the only
it doesn't fix the cash flow. It doesn't, to start to interrupt you, this is part of the cash flow problem that I've been talking about recently. So it doesn't fix
for the states.
Yeah, so the Fed can do bailouts. The Fed can send out $1,200 checks, but that doesn't even cover people's rent in a lot of major metro areas. So it doesn't fix the cash flow problem that society needs to function.
Yeah, but the states have a cash flow problem.
Oh yeah, everyone does.
Yeah, so if the tax receipts are going down, then that's what they need to plug the hole in the pensions. And then it's like, okay, what tax can we increase that people don't have a choice? They have to pay it or they lose their house. Well, it's going to be property taxes or maybe a VAT. There could be a VAT. There could be something unless the Fed comes in and just bails everyone out to where they don't have to do it. But I think it's going to be one or the other. And if I owned a home right now in some place like Illinois, New Jersey, California, I mean, I could not hit the bid fast enough.
How worried are you about rent control?
Very worried. Rent control is one of the most misunderstood price controls in the general population that I've ever seen. Oddly enough, most, even Krugman, agree that as far as economists, agree that rent control is just, it's no good, and not just for the landlord, but more so for the tenant. And I've done a couple videos on this a long time ago, and no one likes them because most people are renters and they want their rent to be cheap, but they don't understand that the quality is going to plummet, and actually it's going to make rent increase faster than it otherwise would. So you might be saying, well, George, that doesn't make any sense at all. How does that work? Well, first and foremost, if you allow rents just to be what they're going to be and you take all the government out of the picture, as you know, there's going to be enough supply to meet the demand and prices are gradually going to come down. But if you're getting in the way of that and you're saying, okay, landlords can only increase their rent by, let's say, 5% per year. Okay, well, I'm a landlord, so I know what I'm going to do. And if I know that I can only do that by 5% per year, I'm going to make sure that I do increase my rent by 5% per year, because number one, I know the supply of housing will go down. Therefore, my pool of renters will go up. I'll have a waiting list for my property. So I know that I can bump my rents by 5%. And I don't have to worry about my tenant leaving, because if they do, I've got 20 other people that are lined up to take the property. But also, if the government crosses the line and says, okay, we're going to control how much rent you can charge, now I'm really worried, because if it's 5% per year now, as far as a bump that they're allowing, who's to say that it's not going to go down to 2 or 1 or 0? So what I'm going to do as a landlord is I'm going to increase my rents as fast as I can to make sure I get ahead of the curve. Where compared that to right now with no rent control, if I have a tenant in there that's well, I'm not going to name any names, but I have a tenant actually that has been there in one of my properties since 2012. 2012, same renter. And they pay their rent, and I purposely haven't raised rents on that property as much as I could have, because why go through the hassle? They're going to take care of the property. They're going to pay their rent. I would rather collect $100 less, $200 less per month, knowing that I've got a tenant in there that's going to be very, very low maintenance. I'm not going to have to evict them. I'm not going to have to find another tenant, as opposed to, kind of rolling the dice and increasing my rents. But if we had rent control, I would bump the price every single year, and they might be SOL as a result. It's all these unintended consequences. It goes back to exactly what the Fed, our conversation there. All these things look great on paper. I get it. I totally get it. Price controls look fantastic on paper, as does socialism. The problem is when you take it from paper into practice, typically on net balance, it's a lot worse for all parties involved.
Exactly. So these governments think, oh, we're just going to stop food prices from rising, or, oh, we're going to stop rent from rising. So we're going to, by decree, by fiat, we're going to say that there's a price control. And then miraculously, shortages happen.
Yeah, exactly.
I mean, President Nixon, when he put in wage and price controls, he knew ahead of time. He said Diocletian in the Roman Empire tried this and it failed, and he still did it anyway.
Yeah, there's a lot of evidence. I mean, it's not like negative interest rates, or we've only had this happening for a couple of years here. You can go back 5,000 years and look at, or I'd assume, and look at price controls and see that they just don't work, which also takes us back to the Fed. And if we know darn well that price controls don't work, why on earth do we think that controlling the price of money will work? That's the insanity that I don't get.
It's all about government spending. For governments, a big government and empire, to have a welfare and warfare state, they have to have this much control.
Yeah, and they've got to have low interest rates. Yeah, they've got to have yield curve control, which is where I think we're most likely headed as well, just like World War II. I mean, Japan instituted yield curve control. I'm not sure if the ECB has explicitly stated that they're doing the same thing. I know, who was it? Was it Brainerd? The gal, you probably remember her name, but I know about 6 months ago, she came out in favor of yield curve control.
Yep.
And yeah, I think that's definitely where we're going. I don't think they're going to have a choice, because even if they get their wish and get inflation, which oddly enough is their kryptonite at the same time, if they get that, they're not going to be able to raise interest rates without crushing the economy and the federal government, everything we've been talking about. So they've got to peg at least, the 10-year, they've got to, I mean, Luke Groman calls it a Frankenstein yield curve, and it makes sense. They just peg it at 0 and then gradually let it go up, just so there's a little bit of an upslope to the curve, so banks can make money on lending. But then they just let the economy run as hot as it's going to go, and just sit back and suffer the consequences while the debt load at least decreases substantially. I mean, I wouldn't call it good news, but if you really want to take a bad situation and look at the glass half full, you can look at the 70s and look at what the debt to GDP was going into the 1970s and what it was in 80. And I don't have the numbers right in front of me. I know exiting the decade, we were right about 30% debt to GDP, which was an extremely low level. And I'm going to just guess that prior to that, we were maybe 50, 60, something like that. So, I mean, I hate to say it, but inflation, if your only objective is to get rid of debt, it does work.
Also, it keeps those government employees pretty highly paid. They're getting pay increases. They have cushy retirements. They have cushy healthcare plans. So they don't get fired. Government doesn't have to cut back, really, at least not the federal government. I don't know what's going to happen with the states and municipalities. Look, there, I mean, Congress is discussing a bailout now. We'll see what happens. But that cash flow problem with real estate throughout society, it is real. So even though there's bailouts, they're going to have to keep doing these bailouts until the economy can get back on its feet or close to pre-coronavirus levels with some cash flow.
Yeah, but see, I think you touched on a point that I haven't heard anybody talk about. And I'm going to address it again in my video tomorrow, because it's just so incredibly important. And that is how the government is using fake CPI numbers to manipulate the entire system and to do their dirty work for them. So as an example, everyone knows how bogus the CPI is. You just go to Shadow Stats and everyone knows that story. But I don't think what most people don't know, and what nobody's talking about, is they're starting, the government they're starting to change the methodology or the measurement for a lot of these government programs that are tied to inflation. So as an example, in 2018, we had this new tax bill that came through, and Trump went out there and said it was the greatest thing ever because it lowered everybody's taxes, blah, blah, blah. And if you just take it at face value, yeah, it lowers people's taxes. But if you read the fine print, you see that they went from using a measurement called CPIU to CCPIU, right? So you say, well, that doesn't sound too much different. Why can that be that? Why is that so bad? Because if you look at a chart, the CCPIU, and I'm not saying it right, it's the newest form of measurement, and it was implemented in 2018. It's on the Fed's website, but it understates inflation relative to the old CPI number they were using, or the measurement of inflation. So why is that a big deal? Because it keeps tax brackets the same, or in the same position, for longer, regardless of what inflation is doing, right? So if we take it again to an extreme to understand it, let's say right now the tax bracket at $50,000 a year, and I know we're conflating effective rates and marginal rates, but just to keep things simple, let's just say that it's 10%, okay? And let's say that the tax rate at $100,000 a year is 50%. Well, if your wages go up just with the rate of inflation, and let's just say they double, so instead of making 50 grand a year, you're making 100, right? But it just went up with inflation. So you have no more purchasing power whatsoever, none. If the tax bracket doesn't go up at the same rate, meaning that 10% tax bracket, you're going to be paying more in taxes. So let's just say that the tax brackets don't change at all. Well, now all of a sudden, you go from a 10% tax bracket to a 50% tax bracket. But you're not making any more, you don't have any more purchasing power. The only thing that changes is a larger percentage of your paycheck is going to the government. So it's a total scam. They increase tax, effectively, they increase your tax rate, while what they say to your face is that they're decreasing your tax rate, and everyone buys it and just goes along with it because they don't read the fine print. So then let's take it to the next step. Well, look at Social Security payments. Well, Social Security payments are tied to the rate of inflation. Okay, well, what if they adjust the measurement for how they measure the inflation? Well, I did this in a prior video as well, and I'll probably do it tomorrow. But I went back, I think it was like over 20 years, and I said, okay, if they lie about the rate of inflation just by, let's say, 1 or 2% a year compounded, that means that the person that's getting $1,000 a month right now in Social Security, if they would have actually measured inflation correctly, they'd be getting $2,000 a month. Your income would double. So you see what the government does by manipulating the inflation rate is they bring in more tax revenue, while at the same time they pay out less money.
It's a scam. Yeah. Ludwig von Mises says inflation is 100% government created. He's talked about that extensively in his writings. And actually, George, it's multiple taxes because you have the stealth tax, the inflation tax, and then your income tax.
Yeah, and your sales tax.
Yeah, yeah. So they just keep, unfortunately, before the coronavirus, I don't know if what the coronavirus is going to do now because of all the bailouts and the liquidity injections. But before, the plan was with manipulating interest rates, financial repression, yield curve control. It was, I called it stagflate and tax and lie, and lying about the economic data.
That's
Yeah,
a great way to
yeah,
put it. Yeah.
yeah. So the phrase is just stagflate and tax and lie. So that's all they had left. And then it was bailouts and rules changes. So it was like stagflate and tax on line, bailouts and rules changes, and that's all that's left.
Yeah, I think it's a great way to describe it.
Well, I've listened to, so you've interviewed a lot of experts. I've interviewed a lot of experts, and I've listened to inflationists, deflationists, hyperinflationists. So I've collected a lot of input from a lot of different people to see what was going on. And yeah, it's all a big scam for so the federal governments don't have to cut back. And then the average person on Main Street, unless they're growing their income, they're entrepreneurial, they figured out what's really happening to protect themselves and grow their wealth, maybe making more money online or something. They're going to get screwed.
Yeah, for sure. I know that's one of the questions you had. I think what I would suggest for people out there to look at this as kind of a glass half full, or there's got to be some sort of opportunity. There's always yin and yang. We've talked about the downside, and there's no lack of that, but there is a lot of upside. And so for younger people out there, what I would suggest, to your point, is if you can learn the online game, you've got to do it. I mean, just start as a side hustle, start evenings, weekends, and not even just for young people. I don't care how old you are. Really, I mean, look at me, I'm 47 and I just started a YouTube channel. So there's no really age peg on it. It's just, I've been on both sides of the coin, Jason. I've been an entrepreneur where I've had to borrow hundreds of thousands of dollars to take massive risk in starting a brick and mortar location or business that you don't know whether it's going to be successful, and you can barely make payroll, and you're not profitable for 6 months, and that's if you're lucky. So you're just praying that you've got enough runway, and that's one of the reasons I've got so much gray hair now. And on the other side, I've also started little businesses online where you have the potential to make just as much profit, but you don't have to lay out 500 grand to do it. You just have to, you come up with $500, you start a URL or start blogging or podcasting or a YouTube channel, and you can figure it out, and you can make a lot of mistakes, right? You can afford to. If your startup costs are 1,000 compared to 500, you can throw a lot of things up against a wall and see what sticks. So that's the first thing that I would suggest people do. Second, and this is probably more skewed towards someone that's young, but maybe not, is if you're excited about a specific industry, go out and just work for free. And I know you probably don't have a lot of time to do that, but even if it's a few hours on the weekends or evenings, just volunteer your time. So you're trading time for experience. A lot of the people that work for me here in Columbia, I've had conversations with them, and you got to keep in mind this YouTube channel is only 8 months, 9 months, something like that. Prior to the YouTube channel, and as you pointed out, I've been a real estate investor since retiring in 2012. And prior to the YouTube channel in 2019, I was doing a TV show locally here. I was the executive producer. I produced it, and I was in the TV show. It was called Vida en Remodelación. It was just a Spanish version of like Flip or Flop, one of these house flipping shows in the States. So that's when I hired the majority of the people that work for me now on the YouTube channel. But in talking to the people, a lot of them just started working for me just because they wanted to learn the business. They wanted to learn how to become a real estate investor and make money. And I think they were lucky enough to get a paid gig doing it. But even if you could go out there and work for free, like let's say you were interested in becoming a hedge fund manager or something like that, just go out and try to find a hedge fund manager. Say, hey, I'll go get the coffee, I'll get the mail. Just let me be in the environment so I can just learn and try to work through just the learning curve there. And it's regardless of the industry, I think that's a great approach. So if you combine that with trying to do something online and just being hyper focused, doing it nights, weekends, and just being and just having that stick to itiveness. I mean, you're doing extremely well right now, but you've been doing it for, geez, I mean, at the very least 6 years. You're just plugging along, you're doing it, you're creating the awesome content that people really enjoy. And it's just a win-win for everyone involved. And I think that's where the real opportunity is moving forward. And taking it to the next level, if you can do that. And I know a lot of people in the United States right now are saying, yeah, but how much money can you make online? Maybe let's just call it $2 or $3 grand. But what they don't understand is that if you now, well, not now because of the virus, but because let's just say the virus is in the rearview mirror, there's so much mobility in the world that you just, like Medellin, Colombia, 3-hour flight from Miami, right? You can go to all these different places. You can geo arbitrage. So even if you're making like $3 grand and you've got some flexibility in your schedule because you're doing things online, you can just move to some place. It's probably a lot nicer than the States, to be frank. And your quality of life will improve, your standard of living, your purchasing power will go through the roof. And it's just because you started this side hustle. So I just see that as a huge opportunity right now.
Yeah, there's definitely opportunity in crisis. So that's some really good advice for young entrepreneurs. And I think apprenticeship is a lost art. And there's the ability to go out and learn valuable skills, whether that's YouTube videos, podcasts, audiobooks, Real Vision TV, Macro Voices, if you want to get into finance, or my channel, or whatever is behind the paywall for only $5 a month. There's tons of stuff out there, and it's not that expensive. So there's not really an excuse. People should have some free time now to do that.
100%.
Well, George, I've kept you for over an hour. You've been very gracious with your time. I want to thank you so much for your time today. If my listeners want to take a look at your YouTube channel, maybe learn about real estate investing, because that was your specialty before your YouTube channel, how do they do so?
They can just check me out on YouTube. It's just my name, George Gammon, typical spelling of George, last name Gammon. They can go to georgegammon.com, or they can go to my Twitter. It's the same thing, George Gammon.
Excellent. Well, thank you so much for your time, and keep up the great work. You are really, I put this on your background there, you are the ass-kicking YouTube channel right now. You're really, I put ass-kicking YouTuber right now. I put that under there because you are doing things in 8 or 9 months that I've never seen anyone do before in our space.
Next time I do an interview, or from moving forward, I'm going to make sure that every single person uses that to announce me. We've got George Gammon on the show. The ass-kicking YouTuber is here.
If you're cool with that, that will be added to the introduction.
Let's do it. Let's do it. Let's do it.